Today we're going to share some thoughts on the market as it stands, both from our sphere of mergers and acquisitions and capital for middle market and lower middle market businesses, as well as our thoughts generally on inflation, interest rates, economic cycles. So grab your coffees and we'll share some thoughts here. Nobody wants to speak too soon, but it feels ideally that we've seen the highest portion of what inflation is likely to look like at this juncture, barring any other wild money printing by the government or outside factors that could disrupt things again. But assuming that there's no black swan events, it feels like at least the high end of inflation is starting to creep back down. Now, that's not in every category. I think I read the other day that over the last 2 years, eggs have outperformed Bitcoin, and that there's actually now cross-border smuggling of eggs, which I still haven't gotten my mind entirely around how that is economically justified, but notwithstanding, the point being that food, rent, certain other key goods and materials have seen and continue to see inflation far beyond the basket CPI rates that are out there. And so, with that being said, other things are starting to come back down. Now, I think, at least from my perspective, where there's going to be some challenges, that there's going to be more and more difficulty the further that rate is to come back down. And so I have a lot of respect for Jay Powell in saying that he's going to bring inflation back down to 2%. A lot of other people are starting to say that they're going to have to give up on that notion at some juncture because it's just going to be too difficult and too much pain is going to need to be incurred by the economy to get there. But the same thing was said relative to Paul Volcker back in the day, and he certainly was able to accomplish that as well. But there was definitely some pain that came along with it. So if you listen to some of the more doomsday sayers of Nouriel Roubini and others, I think there's at least an ounce of truth in that challenge of getting inflation down far enough. Just like transitory inflation, just like other things that didn't necessarily happen, the idea now, or what's being put out there by the market, is that ultimately the Fed's going to shift to a 3 to 4% inflation target and magically be there. And so that's one way of doing it, right? Don't fix your aim, just move the target. But at least directionally, it feels like things are starting to move in the right direction. Now, where I say there's also challenges is not so much just in kind of the conceptual element of bringing inflation down, but wage growth and service costs. And so, okay, and you can look at bread and milk and eggs, but when you look at all different types of services outside of a handful of things that are technologically being deflated, think of costs of televisions, things like that. General services, there's a lot of services out there, whether it's your electric bill or a consulting service, that people have put up 10-20% really without blinking an eye, and people have not only accepted it but expected it. I think we're all in the mindset that if a bill has not gone up over this past year, that we feel like it's almost been discounted. And that can be difficult for an economy, because once you have the thought that inflation will just continue, that both from an employment side, wage growth needs to go higher, as well as from a cost side, it can start to spiral in an upward direction. Now, the interesting thing is we're starting to see somewhat of a white-collar washout in labor, where tech companies are really hacking their OPEX at this point, and thousands of jobs are being let go, while at the same time the blue-collar economy and pricing there on a labor perspective still has a lot of upward momentum. And it's not the worst thing in the world if a real concern out there is wealth disparity, that this does have a compressing effect on that to a degree, that going without delving into the rabbit hole of offshoring of manufacturing, eliminating the middle class 20 years ago. But that being said, for what remnants there are, and we hope that there's more of it, you definitely see a little bit of compression there, which is good to see living wages in certain industries. Now, it's interesting as things go forward, and this is a little bit of a tangent, is whether there's going to be a similar outsourcing or offshoring of white-collar labor. Now, we've worked with companies when we go to sell a business that they say, sure, talk to our intake people, talk to our origination people, talk to our I'm going to connect you with our biz dev person who looks at deals first. So when we're creating new relationships with prospective acquirers or capital providers that are stateside or domestic, their intake people will be in a different country. And it's not this grand disparity of, call it first world or developing countries, but it'll be first world countries in Western Europe or Central Europe. And it's an intriguing notion, but given Zoom, given the ability to communicate, that if there's a cost differential or a talent gap, that it can be sought elsewhere. And so I think part of that ability to offshore, if you will, or outsource white-collar labor will be a reason, and I'd say growing proliferation of online agencies and very specialized service companies will have an effect on labor here. Whether that's a downward factor on compensation or a reason for or layoffs, or more so just an actually successful means of bringing people back into the office, because now if there's a pain of either offshoring or eliminating the position, people will start to return to the office in bigger percentages if they feel like their livelihood is at risk. It'll be interesting to see how this all shakes out. And so when looking at interest rates and how this all translates into the cost of capital, or the implied rate at which an acquirer needs to generate a return when buying a business, it's up from a few years ago, certainly on the interest rate from a lending perspective. And from an acquirer's perspective, what's interesting there is there's so much dry powder out there that maybe some of the outlier or the real overpayments for businesses, we'll see less of that, but there's still very strong appetite, very strong multiples being paid for profitable middle market, lower middle market businesses. We're a little skewed here in that that's the cachet that we solely deal with. And so talking about unprofitable businesses, both on a fast growing or stabilized basis, I do think there's a little bit more value being derived there. You can see from some of the take privates in the tech world, and certainly some consolidated businesses that you wouldn't really know of in the more old line industries where companies were unprofitable but large. But I will say, in the areas that we focus in, again, $400,000 to $4 million, privately held family entrepreneur, small investment group owned companies, there's a tremendous appetite. There's really not any multiples compression. There is certainly a sharper pencil in diligence than perhaps was seen a couple of years ago, but there's a tremendous amount of opportunity. And frankly, barring some unforeseen situation, we really don't see that changing. Where in 2008 and 2009, you had a capital markets that basically seized to a halt, there's definitely a more picky environment in the current situation, but there doesn't seem to be anything that's going to just stop the machine full stop. So the takeaway from all of this is inflation is starting to come down, but it will be increasingly difficult to further reduce it, which will ultimately translate into interest rates that are higher, perhaps just in line with historical norms, the 6 to 7% mortgage or corporate loan. But that looks like it's here to stay for some time, barring any political pressure that ultimately causes the Fed to deviate from its current path. We're likely to see a bit of economic slowdown, but still a lot of action in the space that we focus in. Still a lot of focus on profitable, value-oriented businesses, and businesses that make money, have durable margins, competitive advantages. I still think there'll be lots of pain for non-profitable early-stage companies that don't have a path to profitability, and there may be more distressed companies as those refinancing requirements bring businesses that were, let's call it, insolvent other than abnormal interest rates over the last 2 years. And so I think Buffett said, when the water goes out, you see who's swimming naked. It's a bit of that type of scenario. So good things remain good. Good things are not necessarily at risk. Other things that we're either faking it or hoping to get good in time, they may be a bit out of luck. But again, in our space, still very strong. So that's our thoughts on the economy for this, we'll call it, month. And we'll try to do these types of videos more often here and there. But I hope everyone's week is continuing to go well. Keep pushing forward. God bless. We'll see everyone tomorrow.